I think that the bulls have been right, at least in predicting that demand would respond better than expected in 2017. I think that the bulls have been right also in estimating that the compliance of OPEC members and their associates with the OPEC cuts was going to be higher than what the bears expected. If anything, the bears were expecting a very low level of compliance, and we have seen almost a 95% level of compliance from producers in those cuts. So I think that in those two areas, they were quite correct. I think that the bulls have been wrong in estimating that the US production would not offset most of those cuts from OPEC. I think that the bulls have also been wrong in the fact that oil prices have moved dramatically higher because of a dollar weakness, not because of those fundamental factors. So I think that the near-term outlook for oil prices continues to be of strength because I continue to believe that we can see in the next months that the US dollar will continue to be weak relative to its main trading currencies. We have seen China and Japan selling treasuries. We have seen a very large trade surplus, both in the European Union and in China, and all those effects offset a very strong US economy and a Federal Reserve that is reducing its pace of purchases. However, I come back to the point that what we have seen is a very short term and in the front end of the curve move in oil prices. As such, what I believe is that near term we could continue to see a spike, but that the mid to long term range is unchanged.